Okay, this is Mike Durr, the Kingwood Mortgage Guy, and I get an email every time Dave Ramsey throws out some information on his blog. And this particular one was consistent with a series that we've been doing recently, and I thought it would be a good one to go over with you. For a lot of people that are considering buying a home haven't made that decision yet. And the question is, are you financially ready to buy a home? Now, I in no way want to take any credit for this other than the little embellishments I might add to it. This is a Dave Ramsey blog post. I'm putting it to kind of curating it, if you will, or putting it to the people that I believe might want it, and definitely want to give Dave Ramsey full credit for it. So that being said, let's just move on. We're going to go through this. The question is, are you financially ready to buy a home? And this is my part of the deal where I do an advertisement. I am the Kingwood Mortgage Guy. I've declared that I am the Kingwood Mortgage Guy. I do a lot of mortgages in the Kingwood-Humble area. I also do mortgages all over the state. National Mortgage License Association, my number is 318-989. One of the things I'm most proud of is the reviews that I've gotten on Google. Again, this is something that I really am humble about, but I'm proud of it in the fact that the people that I've dealt with have been kind enough to take the effort to put something on there and kind of state what their experience was like with me. So also, if you want to reach me, you can call me at 281-348-9899. So dreaming of owning your own home, and it might be that you're not just dreaming it, it's more like a driving force, and it could be that your friends are all buying homes, you've got family members that have or own homes, and you feel like you're ready. I mean, there are things that are happening and you just are driven and you're thinking all about owning a home. And I can tell you right now that that's not necessarily a bad thing. It's a good thing. It's usually, if you do it in the right manner, it can be a very positive financial move for you. And we've seen in some of the previous webinars that we did that one of the things that distinguishes a homeowner from people that rent is the substantial increase in their wealth after a certain number of years. So it's something that I encourage. Probably I encourage it a little more than Dave Ramsey, but it may be that his income doesn't depend on it. But I also like to think that the people that we deal with, we're putting in homes that are hopefully in an improving market. The homes that people buy today, I don't think that Texas has got much chance of falling back into any kind of bubble, and I do think that the people are going to, if they hold their homes for 5 to 7 years, they're going to be able to sell it, they're going to make money, and it's going to be the kind of money many times that is life-changing. Another reason you might be thinking about this is that your rent just went up, and you don't want to wait another year. You're have done some things that are right. And what Dave's going to do is he's going to point out some things. But he says one thing, you're not sure what you can afford or if you can even do this. And so his question to you is, how do you know if you're ready? And what we're going to do is we're going to go over 4 things, a small checklist, but it's got a lot of information about that. So let's go over that now. Number 1, are you debt-free with a healthy emergency fund? Are you debt-free? Now, debt-free is all that Dave Ramsey talks about, and it's a big deal. And if you're debt-free, that means that the money that you bring in your income it just puts you in an amazing position to buy a very nice home. And even with a modest income, if you don't have any debt, you can buy a nice home. So the other question is your income stable? Have you been on your job for, they like to see 2 years as stable income, particularly if you've got overtime or if you're commissioned, then 2 years is an important thing. Now, does that mean that you have to be on your job for 2 years before you can buy a house? No, it doesn't. But this would be one of the things that I think would be a strong indication that you are ready. Have you checked the health of your industry that you work in? This is one I threw in, and it's only because we live in Houston and we are dominated by an oil and gas industry that's been reeling this last year or two because of the price of oil. And if you're new to an industry like that, and maybe you just got in, or actually I have a good friend that got into the oil and gas industry 2.5 years ago, and he's not in it any longer. So he's having to reconsider the things that he was doing, and right now there's just not a lot of jobs in it. And then finally, have you met with a mortgage professional and disclosed your financials? Well, this is an important part of it, because if you haven't done that, then you're never going to know. I mean, you're going to be guessing. So you do need to get with somebody like myself, and I'd love for it to be myself, but it doesn't have to be. There are other good quality mortgage professionals out there. You just have to find them. So if that's the case, ask your friends, ask your family, or come see me. That's what I'd obviously like you to do. Okay. Number 2, have you determined how much down you will invest? So one of the things that goes along with buying a house is there's going to be an outlay of money, and you have to determine if you save some money. And according to Dave Ramsey, the best down payment is, guess what? 100%. And that's just like Dave. He doesn't like to have debt for anything, including, it doesn't matter if it's a car, if it's a house, if it's an apartment building or anything else. He wants to pay for it in cash. And if you can do that, obviously I think that's a great idea. The problem is not too many of us can go that high. Now there are a lot of people that can put 20% down, and that's awesome because you pay for nothing additional other than your interest. And by the way, interest rates are pretty darn good right now. So 20% is the best. If you can put 10% down, that is considered very good today also. But you're not shut out if you don't have 10% down. There are programs where you can put down as little as 0 for limited groups. So the programs that you can do 0 down are in the USDA loans. There are some qualifications that you have to go through to qualify for a USDA loan, and it's the property is a criteria, and so is your income, and it has to be medium income, or may even be 80% of the medium income for that area. There also is a great loan, is the veterans loan. If you're a vet, there's not a better loan out there. The interest rates are good, the qualification guidelines are broad, the interest rates are exceptionally good. I think I may have said that. I guess they are really good. And if you're a vet, there's no reason in the world why you'd use any other loan program than what the U.S. gives, and you deserve to use that because it's a great loan. And then for the rest of the people that aren't vets, or maybe don't want to live out in the country in the USDA world, there are conventional and government programs where you can do as little as 3% down, 3.5% down, and 5% down. So there are programs out there, but the key part about this is, have you determined how much down you will invest? And I particularly use that word invest because right now real estate is considered one of the best investments that's available out there. And if you've watched the stock market or the bond market, you know that it's been volatile and it has wild swings, and there are more people that, well, I'm not going to say more people. I can just say from my standpoint, it makes me very nervous to invest my money in something I really don't have a lot of control over. When you're doing real estate, you at least have some control. You get to choose what you want. You get to take care of it. You can improve it. You can paint it. You can landscape it. You can make improvements to it that are going to become a good investment. So you can continue to put money into your properties, and that money has a tendency to come back to you. All right, so number 3, when considering how much you will put down, you have to plan on paying closing costs. Now, this is one of the areas that is not very favorable to a lot of people, but one of the things is that some sellers will cover the closing costs to sweeten the deal. But right now, particularly in this last year and even this year, you can't really bank on that. You used to be able to bank on it because the market wasn't as robust. But now, if you can get a seller to pay closing costs, it's a big deal because there are just not that many houses out there that are staying on the market long enough for anybody to be concerned about selling their homes. So there are a lot of buyers maybe in the upper price ranges that might pay some closing costs. But for many of the houses out there, particularly in the moderate prices, they just go fast. So you can't count on that. So how much are closing costs? Well, the average closing cost can vary between 2 and 5% of the home purchase price. And it really depends on how much you put down, because there are I think 5% is really high, but if you have a modest priced home and you do a tax and insurance escrow account, then you quite likely it could be that much. Put that in perspective, though, on a $200,000 home, that is between $2,000 and $10,000 in closing costs. So not only do you want to consider what you're going to put down for the down payment, but you have to consider the closing costs, the taxes, the insurance that has to be paid in advance, and there are title company fees. And the image I get, or somebody told me this, I don't know, the guy said, you know what, Mike, he says, I appreciate all the work you've done, but I feel like there's like 6 different people that have their hands in my pocket trying to pull all my money out. And I get it, it does seem like a lot, and you really need to kind of make sure you understand what all those costs are. All right, loan costs, closing costs, how much and what are they? Well, they're things like origination charges, and usually a company, a lender like myself, will have some cost. It could be the processing fees, it could be the underwriting fee, it could be the doc preparation, and you're going to have some fees from the lender. There's home and pest inspections, so you want to do a home inspection. The property will generally always have to be appraised. The appraisal is for you, but it's for the lender also. And then you have prepaid property taxes and homeowners insurance. You're going to have recording fees, and you're going to have underwriting fees. So when you get past all this, you can see that it can add up pretty quick. What it doesn't mention on there is there are a lot of title company fees. I probably left those off. I should have put title company fees also. So loan costs. You won't know exactly how much to put aside for closing costs until you receive a loan estimate from your lender. Now that's pretty easy for me because I've got a templated document that I call a detailed mortgage estimate, and I send this out to people. I don't have to take an application from them. All they've got to do is tell me the type of loan that they're going to do, approximately how much down they're going to need, how long they're going to finance it. I can put out this detailed mortgage estimate in a very quick time frame so that they can get up, and it's a pretty darn accurate detailed mortgage estimate. It estimates some title company fees, it estimates what the taxes are, and it estimates what your homeowner's insurance is. But besides that, a lot of the costs are there are calculations, and there's fixed costs that since I've been doing this a long time, I know. So if you ever wanted to get a detailed mortgage estimate for a specific property, specific term, you know what the taxes are, I can tell you it'll be pretty darn accurate. Now you are supposed to receive a loan estimate when you first apply, and then at the end of that you're supposed to receive a final disclosure at least 3 days prior to the close of your loan. As a matter of fact, with the new rules, it's mandatory that that closing disclosure go out to you. Now, and it's supposed to be the final one. In some cases, they're not exactly final, and they're still kind of wondering what all the rules are about that. But it's important that we get that document out to you 3 days ahead of time, and then if it needs to be tweaked, sometimes the title company and the attorneys will tweak it. I always encourage you to review it carefully with your loan professional and make sure you understand everything, because what you don't want to do is you don't want to go into a closing, plop down $30, $40, $50, $60, $70,000, whatever the number is, and not be certain that you got what you paid for. You want to know what the closing costs are, and you should know them up front. So loan professionals should do that. All right, and here's one a lot of people forget about, but there may be moving expenses, so don't forget about those. And I love this. It says whether you pay a moving crew thousands to move and pack your belongings across the country, or you provide pizza to your best friends, you're going to have them. You're going to have moving expenses. So, and it's not just the pizza or the beer that you provide. It could be boxes, it could be bubble wrap, other moving supplies. You're going to have deposits, you're going to have cleaning supplies, you might, obviously most people will get in and they'll paint, and just a bunch of different things. It could be appliances that aren't included in your home purchase. So again, you want to have that set aside. Well, I know this seems like a lot, but we're right here at the end. The summary is this, and of course, are you financially ready to buy a home? Well, a lot of times you're going to have to come see somebody like me. But while you wait for your closing date, because there's a period of about 30 days that's from the time that you go under contract to the time that you'll actually close, you can get estimates of what some of these costs can be. When you're estimating that, I want you to pad the amount you calculate to make sure you have enough. So I'm going to say that again. I want you to pad the amount that you calculate to make sure you have enough. So you plan for the worst, you hope for the best. The other thing is you don't want to let home excitement cause you to overspend. A lot of times you get so excited about what you're going to do with your new home that the budget goes right out the window. Budget being a Dave Ramsey term that he's very particular about. You just got to be disciplined, I guess is the right word. And number 4, this is one we like to talk about because we want you to work with an experienced buyer's agent, because the seller pays their commission and the buyer's agent can save you thousands of dollars by knowing all the rules and red tape that have to happen to come to close. And probably more important than that is they usually know the areas very well. And I always encourage you to get an agent that knows that area, has worked in that area, that knows the subtleties of the neighborhoods and the school districts and just what's going on in that neighborhood. Because when you do that, you're going to win. And the best chance of you making a good decision when you're buying a home is when you have all the information you're supposed to have. So that's generally what I had for tonight. Again, I am the Kingwood Mortgage Guy. My NMLS number is 318989. My phone number is 281-348-9899. I try to put these on every Tuesday, some section of what we're doing. You know what I'm going to do? I'm going to stop this recording and I'm going to answer some of these questions, but I want to thank you for being on here today, and I'll talk to you next week.